Welcome back to the channel. This episode is going to be the coverage of the market statistics and market review that I typically do on the Canadian Real Estate channel. If you saw the most recent video that they had released, you will recognize that Alec and I actually got on a bit of a tangent and end up talking a little bit more about my story and some business strategies, and we didn't quite get to the market statistics. So if you watched that video, thank you. If you're here for the data, we're going to hop into it in 1 second. I promise I'll go through everything that I typically do. So the year over year, month over month data, important metrics that we need to look at, condo market updates, rental market updates, and then lastly, stay until the end because I'm going to talk about who's winning in today's market, key considerations that you need to take into consideration if you're thinking about getting into the market in the next 3, 6, or 12 months. And if you find any value in this video, please give it a like and give my channel a subscribe. I promise I will have more content out to you guys soon. So let's hop into the data. All right, so if you didn't see the other video on the Canadian Real Estate channel, I just wanted to preface this with we have recently rebranded with my team. We were formerly working under the Pace Real Estate Group, but we have recently rebranded to the team name Monstera. So if you start to see some advertisements or you see me refer to Monstera in the future, that is my team, that is my company. And you can see I've got the little logo here on my shirt as well. If you want to know a little bit more about our backstory, about why I chose the name Monstera, and a little bit more about kind of what we do, then make sure that you go and check out the most recent video that I did, the interview with Alec, and we get all into the details about why we made the change and what the name means to us. So let's get into the market data. So market activity in Toronto, year over year and month over month market performance. Let me move myself out of the way here for you guys for a quick second. Just gonna make myself a little bigger here. So we've got the City of Toronto average price points. Now, I like to look at both the year over year and month over month market data for two reasons. So if you were just looking at month over month, just looking at year over year data, you would assume that you're doing relatively well in the marketplace. Detached houses, semi-detached, and condos are pretty much up year over year. In terms of a similar percentage increase, so 13, 13, and 12. Condo apartments, so traditional condo style properties are up about 7% from this time last year. And at the time of this recording, we're talking about June data. We will have July data in the coming weeks, and I'll make another video here so that you guys can see how the market is trending month over month. I much prefer the information that I'm presenting to you guys on this right-hand side of the screen here because it shows us, it gives us some more micro touches on what's happening with the marketplace. So I want to look at what's happened from May to June, so month over month, and then we're going to look at what's happened from the peak of the market, so February to now, so you have a better understanding of what's happening within the City of Toronto, and then how Toronto is also performing to the rest of the GTA. So we're going to look at that in a second. So condo prices from May into June have pulled back about 2.76%. All right, so they were 793. You can see the average price on the right here. So they were about 793, 800K, and we've come down to about 770. So 771. All right, is the average kind of price point for Toronto condos. Townhouses performed the best over the last month, so they've seen a pullback of about 2%. So they basically went from 928,000 to about 909, so 930 to 910 or so. Okay, condo townhouses still haven't breached the 900K price point to the downside, so that's going to be one number that I'm looking for in July to see if we end up breaking that threshold. But we've kind of stayed between the 900 and 975 price point for the last little while. No big surprise, just given the size of the numbers or the overall purchase price for semis and detached to see them have the biggest move to the downside. So semis, we saw almost about a 6% pullback. So we were at 1.425, and we've gone down to just shy of 1.35 for semis. And detached, we saw just over a 9% price decrease. So we were at 1.91, and we've gone down to 1.73. Now, a couple of things, and I'm going to touch on a example of this later, but my projection thought process and why I think condo prices will be the first to stabilize, and why I don't think we're seeing as much of a drastic pullback. So, what I've seen on my end, and just to kind of give you guys a little bit of a scope, um, I run a team in Toronto. We're also expanding to London. So if anybody's watching this video and needs help in London, we can definitely help you out there now. But what I've seen recently is, of course, drastic increases in terms of rental prices. So we're going to talk about rental prices in a little bit. But rental prices are skyrocketing. We're starting to see bidding wars for rentals. People are putting offer presentation dates on their rental listings, that kind of thing right now. So we're seeing this drastic uptick in rental prices. And we are seeing a bunch of people that were in the semi and detached price point that have the affordability to actually purchase property go, yeah, you know what, with rates, um, maybe this is going to be a little bit too much in terms of carrying costs per month. So I start to see, and I saw this with the stress test. Every time there's kind of a big mover in terms of affordability, what I typically see is like the funnel moves down and the people at the bottom always kind of get hurt the most, which is a little bit of a bummer. So if you're a first time buyer or you're someone that has an entry level price point, like pay attention to this. So I've seen people who could afford the detached go, okay, I'm not going to spend the 1.9 or the 1.7. I'm going to bump down to the 1.4, the 1.3 for the semi because I save a bunch of money there, right? In terms of from your monthly affordability or monthly payments. Some people that are in the semis go, I'm not going to buy the semis anymore. I'll go down to the condo townhouse. And then the condo townhouse guys go down to the condos, and everybody just kind of moves down one bucket. Okay. Now, where I think condo people are getting a bit squeezed, and I think this is why we haven't seen such a drastic pullback, is you have rents propping it up, right? So you've got rents moving this way, and you've got people moving in the sector this way, and so that squeezes this bottom portion of the market, this entry level price point. So if you purchased a condo, we'll say in the last couple years, 2, 3 years ago, even further back, you're probably laughing, but you probably are locked into a rate of, 2 to 3%. With current rents right now, depending on what you purchase the property at, it likely doesn't make sense for you to sell your property in today's market if you have the stomach to hold on to it for rental purposes. You may not have purchased the property with the intention of renting it out, but instead of taking a price discount, if you can actually cash flow, like most of our previous clients are actually in a cash flow positive position if they purchased properties a little while ago with the way that the rents are today, it doesn't make sense for you to take a haircut on your purchase price if you're going to make money every month from a tenant sitting in that property, right? So I've seen a lot of landlords go, well, I'm not in a position where I need to actually sell this at a discount. I'll just put a tenant in there and I just won't sell the property for now. So you'll see that in a bit when we talk about listings. We haven't seen a drastic uptick in active inventory or listings come to market. A bunch of people were just like, activity is just dead, right? It doesn't mean that we have a massive pile up of inventory. We just don't have a lot of listings and we just don't have a lot of activities on the listings that we do have. Real estate's just asleep right now, basically. So I think that's one thing to take into consideration. If you are an entry level buyer, you're thinking about getting into the condo market, watch these numbers over the next couple months. Like, these are performing significantly better on a month over month perspective than we're going to look at the GTA stuff in a second when I switch slides here, but I think we're starting to test. I definitely don't want to say the bottom of the market because I don't know, I don't have a crystal ball, but what I've seen is a potential floor test, and we won't know until we look back on this. But I think rents propping up and people realizing, okay, well, I still have the affordability to be able to buy something. I definitely don't want to rent because that's going to be 100% interest. But instead of buying the detached, maybe I'll buy a condo townhouse. Or maybe I can sacrifice and I'll just live in a condo. I just don't want to pay the current rental prices if I have this money sitting around for my down payment that's getting eaten away by inflation and then go back to renting at a higher price than what I was expecting to do. So the condo sector seems to be like this kind of happy medium. It's kind of like the lesser of two evils, right? But it's kind of like this happy medium, and I think we're getting squeezed there because landlords are taking their condos off the market, and people from kind of like the higher portion of the property ladder are now contemplating that segment of the market where they may not have otherwise done that in the past as a result of the rates. Okay, so hopefully that makes sense. Now let's look at sale price by region. So Durham, Again, if you watch my previous month's video, you would have seen that one of the numbers I was looking for this month, similar to how I said we're going to track condos and condo townhouses, was Durham. So Durham was the first, it was kind of like the leader of this price reduction race for the last few months, basically from February. And we had seen Durham to be the first region to crack the $1 million price point to the downside. And so that was one thing that I thought was very interesting to see how the market would react to the average price point being less than a million. Does that all of a sudden start to look more interesting from a freehold perspective? And to me, yeah, again, we only have one data point, so we'll see how this goes next month. But we saw the price reduction slow down drastically. If you remember, Durham was probably 6 to 9% month over month for the last couple months, and now we're about 2.6. So we basically dropped from 995 to 970. And so we had the least reduction in terms of price point in Durham. And I don't know if we're kind of testing um, I don't know if we're testing the market or if we're just starting to see that price reduction slow down a little bit as a result of breaching that $1 million price point. Because now you don't need the 20% to get down, 20% down payment to be able to purchase, that kind of thing. Peel, we saw basically went from 1.18 to 1.1, so about a 6.75% price reduction. Halton held pretty strong as well, 3.3. So basically 1.31 down to 1.27. Toronto as a whole went from 1.233 to 1.15. And then New York region dropped basically from 1.4 to about 1.3 at the end of the day. Okay. Now, where are we at in comparison to the peak of the market? And the peak of the market from, most regions would be February. So if we look at Durham's top, it was 1.2. Current price point, like I said before, was 969, and so we've seen a reduction of about 21% for composite prices. So this takes into consideration condos, condo townhouses, all that kind of stuff. Now, with our team, we typically do around 1,000, 1,200 calls a week, and one of the questions that we ask is, what you know what are you kind of hoping happens in the market, and when would a price reduction be sufficient enough for you to say that's interesting? Maybe I should, contemplate looking back into the market. And it's usually around like the standard answer is 20%. And so again, to my earlier point, I don't know if now because the prices have reduced by 20% that we're starting to see this little bit of let me go back here. That we're starting to see this little bit of I don't want to say a hold, we're still declining, but not as drastic of a decline. I don't know, but we're about 21% here. Peel has come down about 16% from the top of the market. Halton has come down about 17%, and Toronto has come down about, we'll say 5% from the peak of the market. Okay. Just so you guys have a little bit of a reference point. So curious to see how does this perform? What happens when these get to, if they do, 20%? I think they likely will. Do these start to hold at that point in time? And how does the market progress from there? And then overall, Toronto's performed relatively well in comparison to these areas. And I think just as a result of the COVID run up of prices, we didn't really see a run up of prices in Toronto during COVID, but we did in kind of the outskirts. And so, look, my overall opinion of kind of what's happening in the market today, especially when we look at rental prices, someone said this to me the other day, and I kind of agree with it. COVID rental prices are no longer a thing, right? So we saw a drastic reduction. People were paying, like landlords were literally like giving crazy incentives and discounts and all that kind of stuff. People were renting downtown Toronto condos for like $1,200, $1,600, whatever they happen to be. That's gone, right? We literally just rented a one-bedroom place for put it up for 2,200 and it rented at 2,325 within one day. Right. So all of those COVID rental price reductions are now gone. At some point in time, and I don't know when that is going to be, the prices that we are seeing today will no longer be here. This interest rate price reduction, it won't always be this market. So if you're somebody who didn't move during COVID or thought, I have to re-rent at a higher price, I wish I could get those COVID prices, just understand that at some point in time, I don't know when it's going to be, this price reduction or this lull in the market will no longer be there and we'll end up getting back to where we were before. I just don't know what the price point is going to be. It's just interesting to see that happened. We've recovered from that market cycle. We're in a different market cycle. This will recover at some point in time. So just be educated and make an educated decision based on your personal situation. Not financial advice to do anything. I literally don't care if you buy or sell a house right now. What I care about is being able to help people that have determined that this is the right time for them, and then we can facilitate the best move for you if that makes sense. Okay. Now let's look at the Toronto peak to current numbers. Condos have seen a price reduction from 822 to 771, so about 6%. Condo towns have basically gone from 975, like I said, to 909, so 910, so about another, just shy of 7%. Semis have come down about 10%, so 1.5 to 1.35 ish. And detached properties have gone from almost 2.1 to 1.7, so we've seen a 16% price reduction for detached properties as well. Okay, just to take a peek at kind of where we're at. Now let's look at some important metrics. I'm going to make myself smaller here for a second. So this is something that I thought was very interesting because we'll often hear people say, well, TD said this, or Scotia said this, or CMHC is predicting this. I thought it was important to revert back to what their predictions were at the beginning of the pandemic, right? So TD said 6% increase in the overall market. Scotiabank said 4, RBC said 0.2, which basically flat. BMO said no change. CMHC said prices are going to come down by 9 to 18%. Royal LePage said 3% decrease, and CIBC said 5 to 10% in terms of a decrease. So these guys have way more monetary power in terms of their research, and they're significantly more intelligent than I am, and many of the people that I know in this industry are. They all had they weren't it's not too far of a range, but none of them had the exact same prediction. And as far as I'm concerned, none of them predicted what was happening with the real estate market at that point in time accurately, right? They're kind of all over the map. So my point here is take everything, excuse me, take everything, including what I'm saying today, with an absolute grain of salt, right? Nobody has a crystal ball. Again, you can try and time the market as best as you can. Some people will time the market, most people will not. You can try and do whatever you can to say this is the bottom of the market and whatnot. But look, these guys have massive power teams behind them, and they still are typically not absolutely correct with what's going on with the real estate prediction. So if we look at one of the RBC predictions that they released not too long ago, we now expect that Canada's benchmark price to fall more than 10% from peak to trough, with more significant drops of about 13% in BC and Ontario. And if you look at the average stats from when I pulled this, the average home price in May fell to 940, 5% drop from April, and an 11% drop from the peak of the market, which they said was March. So if we take that into consideration, then that means that RBC thinks that we're pretty close to the bottom because they said 13% from peak to trough, and we're currently sitting at 11. I'm not saying that I agree or disagree. What I'm saying is, based on their statistics, based on what they've said, they don't think that we have that much further to go based on this initial prediction. They're obviously continuously updating their predictions as we continue to see these rate hikes. But what my whole point is, do as much research as you possibly can. Come to the most informed conclusion and outlook that you possibly can, and take everything that you read or hear on the internet with a grain of salt. A good deal that is affordable to you, that you have intentions of purchasing and holding for a long period of time, is a great deal if you believe in the market that you're purchasing in long term. If you don't have intentions of keeping the property that you want to purchase now for more than 2 to 5 years, I probably wouldn't buy real estate right now, right? But if you want to buy a house at a discount and you plan on buying that as your family home that you want to keep for 10, 15, 20 years, I think now's a great time to buy real estate if you can stomach the higher monthly payments. Okay, do whatever you want. Again, I don't care. So couple more important statistics, and I think it's important that we look at both of these things, because looking at one in a vacuum can tell the wrong story. So we have our sales to new listings ratio for June was the lowest that it's been in a very, 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 very long time. I think 20 years or so. So we're about 40%. So 40% of new listings are selling, right? it gets a little bit more intricate than that. But if you're just looking at this for just market statistics, we have a 40% sales to new listing ratio, where if you look January and February, it was almost double that. So as we continue to see that ratio go lower, typically if we're below 50%, we're in a buyer's market. Now, the right side of this is months of inventory. As we continue to see more months of inventory build up, and this metric is assuming that no other new inventory hit the market, how long would it take for everything is sitting on the market right now to be gone, basically? So at the beginning of the year, it would have taken, you know, 3/4 of a month, so we'll say 3 weeks for everything to be gone. Extreme sellers market, that means that there's extreme demand, buyers are out there. Right now, we're looking at about 3 months, so not as much buyer demand. However, if we look at this in terms of a ratio of seller market, balance market, and buyer's market, and this is why I think it's important to look at all of the data together, not just one metric in a vacuum, is if you looked at the months of inventory, sorry, this is swapped on here. If you look at the months of inventory here, and we're touching that 3% kind of line, you would still think we're somewhere between a seller's market and a balanced market given the months of inventory. But if you look at the sales to new listings ratio, it looks like we're deep in a buyer's market just given the percentage of sales to new listings. So look at both of these. I think for the bulk of and again, I don't know what region you're sitting and watching this video from, but depending on the region, I think most regions are in a buyer's market right now. However, there are still regions out there that are in AAA school districts, really low inventory, amazing, prestigious streets, that kind of thing, that are still in a seller's market because they're just such highly desirable pockets that don't have a lot of turnover, that are still getting multiple offers. But there's fewer of these than more generic neighborhoods that maybe aren't as prestigious. These guys are probably more on the buyer's market side. These guys are on the seller's market side because there's just a little bit more rarity to this inventory popping up. So look at both of those, but overall, I would say for most people, it's probably a buyer's market out there. Okay. Now, one thing that I thought was super interesting looking at this was how has the market performed after slower cycles, right? So if we look at 2020 being relatively slow, especially for the condo market, 2021 we saw almost a 70% sales to new listings ratio. After 2007, 2008, we saw the highest sales to new listing ratio at 82%. So the market tends to fare pretty well after an economic slowdown. Now you're probably questioning, so you can see here, this is 20-ish years, lowest sales to new listing ratio. The other two are 17 and 18, which is when we had the stress test come in and the non-resident speculation tax. And so those were relatively low. But if we look at 2009, 2021, the sales to new listing ratio have been quite high coming off of a slower year. So just something important to kind of take a peek at. Now, I made reference to this a little bit earlier, but if we look at how the market has performed over the last 4 weeks or so, given what you've read in the news about sellers are panicking and they're just giving away their properties and all that kind of stuff, it's not actually the case. There's definitely deals to be found. There are definitely motivated sellers out there. However, we're not seeing, like I said before, inventory pile up. So these are this blue line is the resale market and the green line is the rental market. We're not seeing this skyrocket in terms of total inventory or a bunch of new listings piling on the market. I think a bunch of sellers are like, look, I've realized that I'm not getting February pricing, still have job security, can hold on to my house, don't really want to sell it at a discount. So I'm just going to take my property off the market. So it was actually this last week was the first time where we actually started to see inventory go down. Now, we're in the middle of the summer right now as I'm making this video, and typically we don't see a ton of new listings. People are just focused on like going to the beach and doing funner stuff than selling their house. So I'm curious to see how this pans out over the next couple of weeks, but it's tracking this. We don't actually have a ton of people who are freaking out putting their houses on the market. We have a lot of people who had their house on the market that are just terminating their listings, or again, like I said earlier, I've seen it many, many times. People were contemplating selling their condo going, I thought I could get a great price. It's not as great as what I thought it was. I kind of had a number in my head. I guess I can't get that number. Not a big deal. I'll just put a tenant in there and I'll rent it out. When the market rebounds, let me know. Right. So that's kind of where we're at with listings right now. If you are contemplating selling your house, earlier this year, you would have expected the property, like, put it on the market, sell within 7 days. We have seen almost a tripling in terms of average days on market since February. So we were basically 8 days here on average, and now we're about 20 days here on average. So again, that's average. So if your area is performing below average, then you need to give yourself some time. If you want to sell your house is likely not selling in 7 days. Your house is likely selling closer to a month. Um, you know, I would say somewhere between 15 and 40 days is probably more normal now. So, unless you are absolutely prepared to go with the most aggressive price point to move the property quickly, give yourself a little bit more time for market exposure. And if you're not getting the activity that you're looking for right away, it's okay. The market is slower right now. All right. But the good news for you is, looking at the previous slide, you don't have as much competition coming to market as what I think most people think that they do right now. Okay. So let's talk about the condo market and then we'll wrap this up. Condo market sales were down about 7%. Now, West average price point is 719 with median being 652. Um, Toronto West had a reduction in total activity, so not prices, but total sales activity by 20%. Toronto Central, which is primarily composed of CO1 and CO8, which is downtown, 4% reduction in activity. Average price is about 810, with the median price being 720. And then East, you have 159 sales, so 3% reduction in market activity, and average price 665 with a median price of 629. Now, this is, I think, like, that's important. This, I think, is more important if you're actually serious about condos. So I've pulled the most condo dense neighborhoods. So CO1, which is like the west end of downtown, CO8, which is the east end of downtown, W06, which is Mimico, CO7, which is North York, and then EO9, which is Scarborough Town Center. Like, if you just look at where the clusters of condos are housed, these are kind of them. So a couple super interesting things. Average price point for CO1, which is traditionally the highest price point, is at 790 right now. So we saw a price reduction from 839 to 790. Biggest pullback this month is in CO1. CO8 is actually outperforming CO1 at this point, and we saw prices go up by 1.6%. So it's very rare that you see, especially like looking at market data over these next months, prices going up. So this is why, to my earlier point, have we tested the bottom of the market? I don't know, but we're seeing more of a floor in the condo market than we are in any other segment at this point in time from what I've seen. So 804 is average price, 731 being median price. Okay, so average and median price is lower in CO1 than CO8. CO7 has a higher average price point and median price point. Price is up 2% month over month. We're at 778, at 793. W06 has come down 1.62%, but again, outpacing the bulk of the market from a price reduction standpoint. So 798 to 778, with a median price of 722, and then EO9 basically went up 5%. So we were at 616. So I haven't seen a move to the upside by 6% in a while, but we saw it in EO9 last month. So what does this mean for me in deciphering the numbers? I think CO1 is like prime for, this is like considered triple A quality real estate. It's, if you're buying a condo, it's in some of the best neighborhoods downtown Toronto, and it's completely on sale. Like, this is literally, it's got a sales sticker all over it. So yeah, I would not pass up the opportunity to look at condos in CO1 if you're actively in the market. It's very unusual to see CO1 average price point be lower than North York and the east end of downtown. So take that for what you will, but I think an area of opportunity has presented itself in that segment of the market downtown. Now, let's talk about rental prices, and then we will wrap this up with some expectations. So every month, I pulled the data for 1 bedroom plus dens in the waterfront communities in CO1 that have to have balcony and parking and have to be over 500 square feet to keep the sample size fair. Okay, so this is one small segment of the market, but at least it gives us a very minute sample size to track how prices are going. So the average rental price in May was $25.88. June was 2668. And again, you can see the volume is like relatively similar. This has gone down a bit, but 93, 110, and 60. So the average price point for July is 2768 to date. So right now we're seeing on average an $80 to $100 a month price increase for rental prices. So this is what I was referring to earlier. A lot of landlords are like, um, it might only cost me $2,300 or $2,400 a month to carry my condo that I had purchased at X price a couple of years ago, especially if I'm locked into that rate. I am not going to sell my property at a discount if I'm going to make 300 or 400 bucks a month for not selling it, right? So this is kind of where we're at. It also, I'm going to show you an example here in a second, but because rental prices have increased so drastically, I know interest rates have also increased, but the numbers are almost exactly the same, right? So we've seen price reduction with rate increases, and then we saw rates were really low, but the prices were higher. If you actually look at the numbers from an affordability perspective, like it's basically the same. It costs you the same. So let's look at an example of this. So this is an example of a one-bedroom condo from February until now. So in February, if you purchased a one-bedroom condo for 600K, you had a mortgage at 2.5, your mortgage payment would have been 1736. I'm assuming the maintenance fees and property taxes are the same because it's the same condo. We're just taking into consideration what's happened in the market. So your carrying cost, your total carrying cost for mortgage maintenance fees and property tax would have been 2543, and your rents are 1950. Okay, so your cash deficit, cash out of pocket, if you're buying this from an investment standpoint, would have been 593 in February. Right now, if prices have come down 50,000 bucks, yes, you're saving 50 grand, woo, but you're also paying twice the interest. So I'm running the numbers at a 4.59% rate. Um, you're looking at 2,200 for your mortgage. Your total carrying cost would be 2,892, but your average rents have increased so drastically to 2,350 that you're actually up 50 bucks a month because it's 542 for a cash deficit. So then you go, okay, cool, but I'm saving the 50 grand. Okay, the pro is, yeah, you save the 50 grand. Awesome. But over 5 years, you're paying $44,000 more in interest to the bank. So it's like, again, on one side, you're giving money to the market, which sucks. On the other side, you're guaranteed giving money to the bank. So you're giving money away one way or the other. So the real differential comes down to like 5,000, whatever it happens to be. I don't know the exact number. We'll say 5 or 6,000 bucks if you actually calculate, the 50 bucks a month plus the interest, whatever it happens to be. You have to make a decision. Like, is the $5,000 or $6,000 over 5 years the big difference maker of you continuing to wait and see? Is that a big enough mover? I don't know. For some people, it probably is. For some people, they're like, oh, I didn't actually even do the math, and I didn't realize that that's how everything was shaken out. So maybe I should actually consider. So overall, things look great on paper when prices come down, especially if you're a purchaser. You're like, oh, amazing, right? I'm going to go buy something for less money. But you also have to take into consideration that you're not just saving the money on the purchase price and just buying at the bottom of the market. Every time prices come down, usually prices come down if rates go up, but you're just paying more over here, right? So the affordability doesn't necessarily always change. You have to actually look at the numbers. Now, let's look at someone who can actually win in today's market, and I think that's upsizers. So who has a strategic advantage to actually take kind of like their unfair share in the market. And those are people that I think that are moving from something smaller and going to something bigger. So for the purposes of this example, I'm using the exact numbers that we looked from peak to current valuations. I'm not like just making this up. I'm actually just taking the numbers from earlier this year. So if you own the average condo and you're moving to the average semi, the price would have been 822. And like I said at the beginning, prices for condos have come down 6.18% from the peak. So the current values are 771. So if you own a condo at the peak, you've lost 50K on average for the average condo. You're like, okay, that sucks. I lost 50K. But you were thinking about earlier this year, oh, I've had a kid or I need to move or whatever the situation is. I want to get a bigger house. So you were going to buy something, you were going to sell at 822, you were going to buy something at 1.5, but semis have actually pulled back 4% more than condos have. So the current valuation for semis have gone from 1.5 to 1.35. So your gain on being able to purchase that house with how much it's come down is 156,000. You're like, okay, not bad. So if we look at the net benefit on the trade, it sucks you're losing 50K, but you're gaining 150 that you wouldn't have otherwise had here. So your net benefit on the trade would be 105,000, not 156, because you're losing 50 here. Plus, you get this little sleeper hit, um, sneaky little savings, which is also saving on land transfer tax, because now you're transferring the land at a lower valuation, which means that you're saving about 6,200 in land transfer tax. So the net benefit is around 111,000. So I think if we're just looking at like face value numbers, this makes sense. Of course, this is just like a hypothetical situation. You have to look at your specific situation and make sure it makes sense. But I think upsizers actually have an advantage. Now, with that, there's a couple key considerations. Job security. So historically, the three segments of the market, three industries of the marketplace that thrive or do very well, or sustain in a recessionary environment, would be healthcare, IT, or government. And I can say the bulk of the clients that we're working actively with today are in healthcare, IT, or working for the government in some capacity, right? The second thing is the ability to stomach higher monthly payments. Yes, you are saving money in the previous example that I gave you, but your payments are going up. So don't, you're saving a bunch of money, but you still need to withstand the cash flow on a monthly basis. And then the third, which is what I mentioned earlier in this video as well, you have to have a long-term outlook on holding this particular property. Making a short-term move in today's market, I don't think is like, it could work out in your benefit, but I think people who have a long-term outlook on holding this property 10, 15, 20 years are hedging and providing some risk mitigation in comparison to those that want to sell in 12 to 24 months. All right. So, a couple final things that you want to take into consideration. I'm speaking specifically to the entry level price point people that I was talking to earlier. And so, with this most recent 1% rate hike, we actually saw um, borrowers' affordability change. So with the previous rate hikes, we hadn't seen the affordability change because we were still under the stress test thresholds, right? And just so you know, so the stress test qualifying rate is 5.25% or 2% above the contract rate. So, and it's whatever's higher. So variable rates before this most previous rate hike were still around 2.5. So if 2.5 plus 2% was 4.5. So the stress test was still at, 5.25%. So your affordability didn't change because you were always being stress tested at 5.25%. Now that the rates have gone up by 1%, the rates are at 3.5, and now we add the 2%. So this second portion of the stress test formula has now kicked in, and so now people are being stress tested at 5.25. So borrowers' affordability with variable rates has actually changed with the rate hikes now, and they're going to change likely more as if we see further rate hikes, right? So I have a lot of people that I've talked to who are like, I'm just going to wait and see, because if the rate hikes continue, prices are going to keep coming down. Right now is a pivotal moment where prices might continue to come down, but your affordability is also coming down. And so there's three scenarios. And the reason I'm saying this is because I have one client who is wanted to purchase around 550 like 550 for a condo, right? In February, she was like, just get me anything, but didn't have all her ducks in a row, right? Now, all of a sudden, all of these properties have come into her criteria that are now great options for her. And she's like, maybe I should wait and see if I can continue to get more house for my money if prices come down. So as of the last rate hike, her affordability has gone from 550 to, I believe, 525 or so now, right? So now we're gambling a little bit if she continues to wait. And again, it's her decision. I'm just here to provide the information. She can do whatever she wants. But all of the houses that were all of the condos that were 550, right? She now, in order to still be able to purchase those ones that she could have purchased a couple weeks ago, they need to come down to the 525 price point, because now she can't go to 550. She's at 525 because of the stress test, right? So we have a couple of different scenarios that you need to take into consideration if you're a borrower right now. So 3 outcomes. Rates continue to increase, prices come down, and your affordability comes down, and they move together in tandem, right? So you could borrow at 550, and you could borrow at 550, and the prices were 550. You said you were going to wait. Now your affordability goes to 525, and prices come down to 525, so they move in tandem. You're no better or no worse. You're buying the same thing. Yes, it's a discounted price, but your actual payments are the same. Your affordability has just gone down a little bit. Okay. Scenario two, uh, interest rates go up again. Somehow your affordability doesn't change and prices come down quicker than your affordability changes. You are in a better position. The alternative is, and this is where I'm curious, and I think that it's a little bit more of a gamble in the condo market today, with rates propping things up, and again, people coming from these other sectors of the property ladder. If we start to see the bottom tested in the condo market around, like, let's say 550, and you could borrow 550, but your affordability goes down, you are now in a worse position because you can't afford the thing that you once got, and this isn't coming down any further, so you're losing leverage. And between 450 and 550, if anybody's in that kind of price point for condos, trust me, you know what the inventory differential looks like. It's probably 3 or 4 times as high at 550 than 450. So as soon as you kind of get closer to that 500K mark, it becomes more difficult. So of course, this is all in theory, but and again, my recommendation is this: if you're contemplating doing anything, talk to your broker right now and understand what's going to happen as further rate hikes happen. If they do, like, if rates go up by another 0.5%, what does that do for your affordability? Because right now, if you're borrowing variable, it is going to go down. You're going to be able to afford less, and so you're hoping that prices come down quicker than your affordability comes down, or that they come down at least at the same level, but you're not in any different position. So that is what I got for you guys today. I hope you guys found some value. I know this is a little bit longer than they typically go. I had a lot of stuff to cover today. So again, if you found any value in this video, please like and subscribe, and I will see you guys in the next one.